Good afternoon, everybody. Welcome to TraderMerlin Show for your Thursday edition. The fireworks have begun. The popcorn is all over the place. It's pretty much a one-directional popcorn trade of the day. Let me get that popcorn graphic in there for you. There you go. Wild one, to be sure. We'll talk near the end of the program about Apple's earnings, which was rather disappointing. We'll talk about Amazon's earnings, which was legendary, and then Meta's earnings, which was just off the charts. Quite literally, it was up like 18% or something, getting close to 18% gain in the after hours. But I don't want to waste our time talking about that. We have a bigger topic at hand. Certainly the earnings for those companies is a major driver of markets. But we also had a major event yesterday, which was Jerome Powell and the Federal Reserve, FOMC, making their rate statement, which was totally predictable. I don't think anybody expected differently with regards to what was said to the rate announcement, meaning it's paused. But there was some talk about what was going to happen going forward. And typically the mainstream media is focused on what was the rate change. Was it a hold? Was it a raise? Was it a cut? That's all I want to know. But behind that, there's so many different elements that are driving these markets, and I'm not very proficient at those. But my guest today, who I affectionately call the Bond King, Mr. Bill Addiss, is going to give us a bond market update. And you can see by my graphic here, guys, I've got Bill in front of some presidential-looking building. It was supposed to be the Federal Reserve with piles of paper, because I know he sifts through these documents, trying to glean some little Easter egg of joy and Fed announcement. Bill, how you doing, my friend?
I'm doing great, Merlin. How are you, my friend? How's today?
Great. I'm short the NASDAQ, so it's not great. We're up 2.2% right now, but it's okay. I'm still
short that equity market. I too am short that equity market.
yeah.
I should know better. I'm a bond guy. I should know better than to touch the world of equities.
Right, stick to what you know, man. You know that. No, yep. It's a tough one. But going into this week, we talked about this last Friday. I said, we've got. This week is probably the most eventful for at least the next couple of months because of the major earnings announcements. You have 5 of the Magnificent 7 stocks. And I wanted to short bigger, but I didn't do a huge position. So I feel fine about that. We'll see. I've got a stop loss in place, as you should. If I get stopped out, no big deal. But let's shift. I want to talk about bonds since I got you here, and that's your area of expertise. Some interesting things were said yesterday. I gave my 2 cents on yesterday's show. Walk me through your perspective, thoughts about what the Jerome Powell said, and maybe the stance by the FOMC.
Yeah, as from a policy point of view, there was literally no change, and it was right in line with expectations, like every other major central bank in the world is doing right now. This week, we're all on pause, and that was expected. I've heard you make reference, and we were talking earlier, though, that for those naysayers who thought there still might be a raise down the road, because I too have to point out right up front, we still have not hit the Fed target rates. Mm-hmm. The whole reason they brought those rates up was to curtail inflation that still hasn't hit the target goals. So I'm not saying I was one of those looking for continued rate hikes. Don't get me wrong. I'm not of that camp. But there are those people who say if Powell was vigilant about what he says, then there has to be more hikes. I think he pretty well took that expectation off the table.
Yeah.
So, the big question is, okay, they're done raising. Are we going to be in a higher for longer mentality, which I'm of that camp, or will the Fed be as aggressive on the cuts as they were on the hikes? Mm-hmm. And if they are going to be aggressive on the cuts, when? I mean, that's what the market is waiting for. And the honest answer is nobody knows.
Right.
It really does depend on the data. Between now and the March meeting, we've got 2 months of CPI to be released. We've got 2 months of unemployment, 2 months of data. So the Fed's going to be taking a look at this. But are they inclined to want to cut? Absolutely.
Sure. Yeah. I mean, a cut makes everybody feel like everything is warm and fuzzy. And I see Mick here saying I'm in the raise camp. Unless we see dramatic change, I'm not in the raise camp anymore. I think I read yesterday Jerome Powell's comment, which says, we believe that our policy rate is likely at its peak for this tightening cycle. I think he's pretty much signaling to everybody, we're not going to raise anymore, but we're not saying that we're going to cut right now. We'll probably hold here for a while. And remember, we looked at this the first day of January, and the market has expected well over 6 cuts by the Fed this year. And the Fed probably not going to cut that much. It would probably be 2.5 if you look at, they said they'd be on average at 4.6 by the end of this year. Right now, the market is expecting much lower than that.
the market has been overly pricing this drop. You know, if you go back to the beginning of the year, as you said, they were pricing in 6 cuts this year. Well, assuming 25 basis points, 150 basis points cut in rates with a start in March. Now you look, as you said, we're now got 4 pricing cuts in the market, 3 to 4, with only a 50% probability now of a cut in March.
Mm-hmm.
Again, I'm not looking for a cut in March. I really think, I keep saying it, until we reach our goals, the Fed's not going to be cutting.
Right.
I also say that before they start cutting, they also have to deal with the tapering situation. For them to start cutting rates while at the same time tapering is they're polluting their own pool, to say the least.
Talk to me about the tapering side of things, because he made a point in there. He says, he wants to make it look like the Fed is doing some great things. So he highlighted the fact that they've raised 5.25 points in the last 2 years, which is pretty impressive. And they've also unwound their security holdings by $1.3 trillion, to which, before the show, I was laughing with you. It's like, he's all proud that, hey, we sold $1.3 trillion worth of our balance sheet. Well, yeah, a-hole. You didn't say anything about how you juiced it up, $6-7 trillion in a couple of years either. So right. Let's be fair here.
Quantitative easing on steroids, as we talked about it, right? They were out there buying everything they could get their hands on.
Unbelievable.
Yeah, no, but go ahead. I'm sorry.
No, you're right. Go ahead.
But in fairness, I mean, what they want to do is working. And yep. A lot of people have trouble understanding this. So just to demystify some of the terminology. So, when the Fed was easing, they were just creating boatloads of money. As Merlin just said, about 4.6 trillion in just 6 months, but about 6 trillion over the entire pandemic. That's how much cash they dumped into our economy. Now, when they're saying, okay, inflation's now a problem, we have too much cash. Now what we have to do is start pulling that cash out. And literally one of the ways they're doing it is they are committing to destroying cash every month. And they're destroying $96 billion every month, literally just reversing what they did under QE. So the goal of that is to pull liquidity out of the market, pull cash out of the market, and that actually puts upward pressure to interest rates. The fact that cash is less available. The things the Fed has to do to create that cash is sometimes some months they have to sell some of their bonds. Right. So the Fed had been a big buyer. Now the Fed's starting to sell. That puts downward pressure on prices, upward pressure on yields. Yeah. So by tapering, the Fed is actually raising long-term interest rates. And so they're going to do that at the same time they're going to start dropping this end of the curve. That's illogical. Well, so, maybe they'll do it at the same time. They don't have to do it in advance, but they're putting market forces against each other if they continue to taper and while at the same time they start dropping rates.
Yeah. I've got your graphic up here, which is from the Federal Reserve Board, which is of the tapering. And, just for everybody out there, this should make you all just freak out a little bit. Because if you look back at yes. 2008, 2009, when we hit the financial crisis that, that shook the world, we went from just under $1 trillion to about 2.2 trillion, which was crazy. And then all of a sudden, nobody really said anything about that. We kept on printing and printing. So we printed all the way from 2009 to 2015, just more money, more money. We got up to about 4.5 trillion. It was like, oh, wow, well, that's a lot. Well, that was over a period of almost 6 years. And in a period of 2 years, we went from 4 trillion to 9 trillion. And what could possibly go wrong? And, he's definitely gloating about unwinding this balance sheet. But keep in mind, when they are buying all this to prop the markets up, that has one impact. But when you're unwinding it, you're going to have the opposite impact on it. And kind of just waiting for that to hit. It hasn't really hit the market from my perspective yet, Bill. When do you think it will, or is it?
No, I think the market's been preoccupied. We knew in the past when the Fed had announced they were going to do this tapering type concept back in 2015, the equity markets and other markets really didn't like that. Your audience can Google the word taper tantrum to see it's actually become a thing in economics terms. So the market really took the announcement that the Fed was going to be destroying this money rather well. Because normally tapering scares the equity market. They like having all this cash in the system. So if the Fed stops tapering, I would say that's going to put another upward bias to equities. Keeps more cash in the economy. The Fed's not out there burning it.
Yep.
Many people feel that all this cash the Fed created created some, I don't want to say bubbles, but overvaluations during the pandemic, right? Look what happened to real estate. Look what happened to the equity market.
Right.
Look what happened to crypto. I mean, there were a lot of assets that really did quite well during the pandemic. And a lot of people feel that all this money was the catalyst for that. So you start destroying that money, the assets aren't going to like that.
Yeah, it certainly had. It certainly had an impact on it. I mean, it was not the sole catalyst for sure, but certainly had an impact on it.
Nor is anything. Absolutely, no. It's just one of many factors. Absolutely.
As they unwind their balance sheet, walk us through what actually is being sold. I'm saying this almost rhetorically. I know the answer, but I would like you to explain it, because I know we have some new viewers here. But what exactly are they selling? So they bought all these assets. What were those, and what are they selling?
So before we even get to the selling part, there's another part first. So to explain, here's the Fed. As a result of all this quantitative easing, they now have the largest bond portfolio in the world. They've got over, as you just saw at one point, over $9 trillion worth of assets, most of it in the form of bonds. And that bonds is really at this point in two different portfolios. One is a treasury portfolio and the other is a mortgage portfolio. The Fed is the largest holder of mortgage-backed bonds as well. So from these two portfolios, every month, this portfolio is generating a huge amount of interest. I mean, it literally, when the government pays its interest on its treasuries, the Fed gets the largest check because they hold the most amount of bonds. So when the government's paying the interest, they're paying it to the Fed.
That's crazy.
So I know, isn't it? So if we look at this portfolio, what the Fed has said is out of our treasury portfolio, we're going to destroy $60 billion a month. And I'll come back to that. Then out of the mortgage portfolio, we're going to destroy $36 billion a month. So there's the $96 billion that the Fed is committed to. So what the Fed does every month is, let's just look at this treasury portfolio. The first $60 billion of interest payments that come into this portfolio, literally the Fed destroys that money electronically with the push of a button. That $60 billion disappears. So the money the government is paying, which by the way is part of our debt problem, the money the government is paying on the interest on the bonds, the Fed is literally destroying that money. Now, some months, the problem is that portfolio doesn't generate $60 million in interest. So on those months, the Fed has to maintain that commitment. If they're not getting enough interest payments, then some months they have to go in and start selling their bonds to get the proceeds from those sales and then destroy that money. Now, on the mortgage side, the mortgage portfolio has actually been consistently generating enough interest into the portfolio to cover that $36 billion. So the Fed hasn't had to yet be a seller of mortgage bonds to meet their commitment. But now, many months on the Treasury side, they do. So again, and sorry for I'm oversimplifying it, but if the Fed is in there now consistently starting to sell, that puts downward pressure on rates, downward pressure on prices, upward pressure on yields. And that would be the opposite of what they're going to be doing if they start tapering, if they start dropping rates.
Right. And they have it's not like they're all in short-term maturities either. They have a full spectrum of them.
Actually, the single largest section of their portfolio is 10 years on, because when the Fed was doing QE, the whole purpose of printing this money and buying all these bonds was to drive long-term rates down. The short end of the yield curve, they control with the Fed funds rate. They don't really have traditionally control of long-term interest rates. The whole purpose of QE was to print all this money so they could drive long-term rates down.
Yeah.
By buying all those bonds. That's what QE was all about.
So then riddle me this, Batman. It's tough. And I thank you for the explanation. It's great because I wanted people to understand that they have this whole spectrum of bonds, but they're really doing mainly the long end. You look at what's happened in the 10-year since September of last year, we were over 5%. And my thought was we were going to see that probably hit 6 by the end of the year just because the trajectory and trend is your friend till the bend at the end. All of a sudden, we fell from over 5%. I'll share that chart with everybody watching at home to 3.8. And that was back on right at the end of December. Fantastic sell-off. That was certainly a nice little juice for the real estate market. We had a rally back up to about 4.2, and all of a sudden, in the past week and a half to 2 weeks, we're falling off a cliff here again and rushing towards that 3.8. And if the Fed is unwinding their balance sheet, which has a lot of 10 years in it, that would lead me to believe that yields should be surging. And I feel like I'm missing something here. Is it? What's amiss?
Again, No, there's nothing amiss because your logic is sound. But again, kind of like we said with our earlier discussion, this is only one of a myriad of factors.
Right.
For example, we've talked about the overabundance of more supply that keeps coming in because our deficit keeps getting worse and worse. We're now selling more treasuries than we ever have. That should also put upward pressure on rates.
Right.
The fact that the Fed is doing the tapering should also put upward pressure on rates. What we continue to be amazed by, and we've had this discussion too, is there are global investors out there who are willing to buy U.S. treasuries. We have good demand for our treasuries. We are damn lucky.
Yeah.
Because we got a lot of factors potentially working against us. And yet, in spite of that, we get 2.5 times as many buyers for our bonds as we have bonds to sell. We are very lucky.
Yeah, well, and I think part of it is it's markets, again, setting expectations. And if the Fed has said, like they mentioned yesterday, that we believe that we've peaked as far as raising for this tightening cycle, that we're not going to see rates increase anymore. And therefore, if they start to drop, people are going, oh, well, I better lock in some long-term bonds here. Now you're creating more buyers for the long term. And I think that's one of the factors out there. But if they don't,
Absolutely.
if they don't lower as much as expected, there may be some opportunity for some bounces here in that 10-year. But it's been an unusual chart, to say the least.
Surprising strength. I have to agree. I could give you a myriad of factors why rates should be higher, including inflation, supply, all the things we've been talking about. And yet we continue to see strong demand. And a lot of it, let's be honest, and it doesn't matter. A buyer's a buyer, is not domestic, it's overseas.
Yeah. Edward says, what does Bill mean when he says the Fed destroys the money? They literally destroy it.
They literally push a button and they destroy it. And that's how they created it. You want me to take a minute to?
Yeah, go for it.
Yeah, sure. Merlin? Okay. So let me give you my Fed destroy money rap. So, when I say the Fed creates and destroys money, I'm sure everybody in the room was thinking the printing presses are going.
Right.
That's not the way we create money in today's world. Because in today's world, when we talk about the U.S. money, all right, that only 4% of that money is actually in the form of bills and coins. 96% of our money here in the U.S. is virtual. Your money's virtual. It's sitting in a bank. Right? Yeah. Against the virtual money sitting in your bank, you have automatic withdrawals, you have, different things. I would ask your audience to think on an individual basis of your compensation. How much of it do you actually ever convert into the bills and coins that we walk around with? A very small amount.
I might be your 4%,
and there's our 4%, exactly.
I mean, I always keep a little bit of spending cash, but I wouldn't even say it's 4%. Right. It's probably less than 1%, a few $100 in cash. And
exactly. And think of that as the whole economy.
Right.
So 96%. So I love when people say, gee, do you think the US dollar will ever go digital? It's virtual already. 96% of our money is already virtual.
Right.
So what literally is happening, now this is the Federal Reserve. You and I can't legally do this. So let me give you an example as to how they created the money. And I can do this all in 2 minutes. So back during the pandemic, when the Fed was buying all those treasuries, they would reach out to the dealers and they'd say, okay, I want to buy 5 million of the 10-year treasury. And let's say they call Citibank and Citibank gives them a price. They decide, okay, we're going to buy it. So tomorrow, Citibank is going to deliver those treasuries to the Fed. They bought them, they own them, they get them. And tomorrow, Citibank has to pay, the Fed has to pay Citibank for those bonds. So what the Fed was doing during the pandemic is every time they had to pay for a trade, they would literally, with a push of a button, put that money in the dealer's bank account. Citibank got paid for the 5 million treasuries. When with a push of a button, the Fed can affect the deposits. And that was literally money that didn't exist the nanosecond before. It was virtually, now you and I try and do that, we go to jail. Mm-hmm. This is what the Fed's job is. What many people don't understand is that cash in our economy, how much money we have, is not a function of the government. Government doesn't control cash in the U.S. economy. The Fed does. Right. And when they made a decision to print up $4.6 trillion during the pandemic, who in the government approved that? Nobody. Howell and his crew had the authority to do that. So literally, during the summer of the pandemic of 2020, every day, the Fed was buying $13.5 billion worth of bonds every day.
Wow.
Just sitting there, pushing the button, putting all this money in the bank accounts. $13.5 billion every day.
Crazy.
So now they've decided there's too much money, right? So now that they've got this huge portfolio that they amassed with all this money that they virtually created, now as the interest payments are coming in from the government, to the Fed to pay them for the interest on the bonds, the Fed is literally pushing the next button, and they're with a push of a button destroying electronically that first $30 billion, pardon me, 65 billion,
65.
the 60 billion that comes into the portfolio.
That's
Money's
insane.
virtual, and the Fed has the authority to create and destroy it with the push of a button.
Man, my life would be so different.
Yeah, you would be in jail if you and I tried that.
Yes,
That's
yes.
how different it would be.
And it would happen very quickly that I'd be in jail printing that kind of money. Yeah, it's pretty crazy to think. And people you hear it all the time, the printing press, that the Fed's printing money. And it's a little bit of a misnomer. They're not really printing anything. Almost everything now is digital, which, that'll get even worse in the next decade as we get to something like the central bank digital currency and more digital assets. But yeah, it's just, how much do we need? You need 60 billion? Okay, we got it. Always have it anytime you need. It's called overdraft protection, is what it is.
Yeah.
It's
and it is. It absolutely is. I mean, the Fed has the authority at will to create and destroy.
unbelievable.
And most people don't realize they have that authority.
Yeah, it's a strange conundrum. Let's go to a couple of other questions. Ooh, good one here, and we're gonna bounce around, Bill, just because the questions come in, and I always like to tailor this towards the viewers. Lisa says, "What's the scoop on iBonds right now?" So iBonds were the hottest kid in town for a while.
Great
Now all of a
question.
sudden,
Great question. And we talked about this at the last XLT I did last month. And I also reposted an article on my LinkedIn account, which a lot of your people connect with. It is time to reevaluate iBonds, perhaps. We were at the forefront as inflation was spiking. So the coupons were at 9.6% when you and I first started. And this is an inflation-linked note. So we knew going into this trade that as inflation comes down, which it would over time, that the coupon and the rate of return on these bonds would go down. So, it's acting exactly as we expected. The question is how long we were going to enjoy the high rate of income.
right?
And I would make the argument, thanks to Janet Yellen, who, remember, has juiced up the yield for us, and the fact that inflation has been a little bit stickier than we would like, the iBonds continue to offer an attractive rate of return. I think the last coupon set in November was 5.26 or 5.27. And that was an extra point kicked in by the Treasury Secretary.
So you're still beating CD rates. You're still beating
exactly,
CDs.
And that's where I go. But I do think, that as rates, if inflation does do what many people are expecting, it might be time to reevaluate your iBonds. So if I could just take a minute to explain and remind people of their liquidity. So when you bought the iBond, you were technically buying a 30-year certificate. That's what you bought. You were buying a 30-year deposit. But it offers different liquidity. So if you wanted to redeem your iBond, now you're not going to sell it. You're going to redeem it back to treasurydirect.gov. You cannot redeem it within the first year. There's a lockout period there. But once your 1 year period is over, from years 1+ to 5 years, you can redeem your iBond, but you're going to get hit with a 3-month interest penalty. And specifically, it's your last 3 months,
right,
which is the lowest.
Right. Fine with that.
So yeah, right. Exactly. You don't lose your 9% if you jumped in early. So you lose your last 3 months worth of interest. But if inflation is going to go down, taking that 3-month hit might be worthwhile. Mm-hmm. Now, after 5 years, you have no penalties whatsoever. You can just redeem it and you can, you earned your interest up to that point. So based on your point of entry, when you jumped into this, and based on where you think inflation might be going, it is worth considering that maybe, okay, it was a great opportunity, but it's time to move on.
Yep. As Big Eb points out, he says right now you got 5.27 through April of this year. Yeah, great. If inflation plummets and all of a sudden it's at 1% inflation, you're still going to get paid that 5.27 to April, but that April rebalance might be very unattractive. And at that point, maybe you cancel out there and move on to something else, because I know right now you can get 5.2, 5.3% for CDs, which that's an attractive rate. But I know there's many people in here, including myself, that I got in that last day to lock in that 9%, and I got 9% for 6 months. That'll offset quite a bit of future lower rates.
Exactly. So that'll cover some pain in the short term, but I don't think there's going to be a lot of pain. But again, it really depends once again on what the prospect of inflation is. But at this point, it's at least worth taking a look at and seeing, what's your cost basis and how much pain are you willing to put up with.
Right. Dwight says, what makes bonds so lucrative that the U.S. bonds have so many buyers? Basically, why are we kind of that focal point for global consumers of bonds?
Great question. And it's a real simple answer. As I'm indicating to you, most of those buyers are offshore. So for example, if we look right now, who's the largest buyer of bonds or holder of bonds, as we've been talking about? It's the Fed, right? But right behind them is Saudi government and the Kuwait government are actually I forget who's number 2. They're number 3 and 4. Many people think China and Japan are big buyers, not for years. They used to be for reasons we could get into, but that's history. So if we look at what's going on today, Saudi and Kuwait are the number 2 and number 3 buyers of bonds. Now, why are Saudi and Kuwait buying bonds? Quite simple. They sell oil. And no matter where in the world you sell oil, it's paid for in dollars. So the Saudi government, which honestly is a client of mine, as is the Kuwait government, as a matter of fact, but these governments are sitting on huge amounts of dollars from their oil sales. So they're simply taking the dollars that they have and investing in a dollar-denominated liquid investment. They're not making a political statement. They're not saying, gee, we like the U.S. economy better than ours. And by the way, the value of the Saudi rial is somewhat pegged to the dollar, so there's a benefit there. But they're simply saying, we got dollars, let's invest dollars. Kuwaiti government is doing exactly the same thing. Venezuela, until certain tariff issues came into play. So if countries are exporting oil, the reality is countries then become buyers of our bonds. Which brings up my nightmare scenario, which started this year. Mm-hmm. Starting this year, for the first time, OPEC is now doing trades, not in dollars, but in local currency. They're doing trades with India in rupees. That scares the heck out of me, because now it means India is not going to be buying the treasury, Saudi is not going to have to buy as many US dollar denominated assets, because now they're going to start having rupee denominated assets. They're going to buy Indian bonds. Right. There's my nightmare scenario.
Walk me through, everything is just a hypothesis at this point. But we get to the point that Saudi, which historically was buying things in U.S. dollars, taking those dollars, buying bonds, and kind of propping us up. Really, they're helping us out, but they're also earning some yield on their money. If we get to the point that Saudi's like, hey, wait a minute, I've got China wants some oil, I'll sell it to them in yuan. That's fine, because I can convert that through a bank. I've got either euros, whatever currency it is, I'll accept whatever currency you throw at me. What sort of damage does that do to the U.S.? Obviously we know it would diminish the power of the United States, but what's that ripple effect on the economy that you would foresee happening because of something like that?
Catastrophic. Absolutely catastrophic. Oof. And I'll quote Jamie Dimon, because this all comes back to the deficit, right? The reason we have to issue all these bonds is because of the fiscal irresponsibility of our elected officials.
Right.
We're incurring the largest deficits in history, and the pandemic's over. The government stimulus is gone, and yet the government continues to overspend at the same levels when they were doing all those government giveaway programs. And to quote Jamie Dimon, who I do have great respect for, this is a cliff that we're approaching at 60 miles an hour.
Yeah,
this is a problem that somebody has to pay attention to. So, we are fortunate. Our elected officials, in my opinion, are irresponsible and overspend so much, but they're being backstopped by all the support we're getting from these foreign dollars coming in. Mm-hmm. Those dollars could disappear dramatically. The net result is interest rates would skyrocket dramatically.
Yeah.
All right. And I don't know that our elected officials can even possible to curtail their spending ways. I don't, they'll probably respond with more stimulus. They'll create more deficit. I could create a real bleak scenario for the U.S. dollar and the U.S. economy.
Well, with that, I always try to look at it from, let's give me the bleak scenario, but then give me, the ultimate great scenario. And, there's a couple choices here. So number one is you've put some pressure on oil producers that says, we'll force you to take dollars. Of course, that's going to use military might. I don't think that's the way it's going to be. Or you start putting sanctions on these countries until they accept dollars. But now all of a sudden you're just making yourself out to be a big bully, even more so than we already are. So I don't think that's the route. So if you let them go free and let them accept whatever currency they want, then that slowly over the period of the next 3, 5, maybe 10 years is going to start. It's not going to be a hit the switch and all of a sudden we're in deep doo-doo. But it's going to be harder for them to sell those bonds, and therefore that yield is going to start to surge. Our credit quality will probably continue to drop, which will cause the yields to go up even more. And eventually we're going to be going, hey, I'm buying India's bonds because they're more stable.
Exactly. No, and not to tie politics into it too much, but we can't ignore it totally. It is no surprise that the U.S. rewards the Saudi government for the system by the military support that we give them.
Yeah.
For them to turn their back on the dollar means they're going to sacrifice a lot on the military side, and we can't deny the kind of interrelationship between this all.
Yeah, absolutely. Oh, strange stuff. Let's see. What else did you have? You had one earlier. Let's see. I think you had this chart. No, we had the tapering the Fed one that I brought up already. You had the where we are today with regard to the Treasury yield.
And the Fed funds chart. I just wanted to remind people, maybe that was the one, the Fed funds chart?
Yeah, the first one, yeah.
Yeah, I just wanted to point out, for those people who have been in the markets for only 20 years, babies, if you look at today's interest rate, it really is at an all-time high over that 20-year period. So when people say, rates are high, it depends on your perspective, I guess. Over the last, this decade, 2 decades, this millennium, yeah. But I do want to put some historical context to this, and that's all I was trying to show here. The white hair that I've earned.
Yes,
interest rates we've seen, we've seen interest rates a heck of a lot higher than this. So I was just trying to give things a little bit of perspective. When I hear talking heads on TV say, we're at record highs on Fed funds, it's like, well, what's your time frame?
Yeah, we are for the last 10 years.
Right. So when the Fed wants to be proactive, they certainly will be.
A question came in from, let's see, that was from Liz. Says, but Bill, the Jenny Yellen freebie juicer is only for people buying bonds after they introduce, right? And my understanding is for everybody, every holder, right?
Yeah, no, when the coupon was set, so we're referring to the Ibon coupon, right?
Yep.
Just want to make sure. Okay, so when they set the Ibon coupon, the first component is the floating rate component, and that's the function of the CPI rate. And now, I forget the exact numbers, but that was about 4.25% on the November reset. But the Treasury Secretary, at her discretion, has the authority to increase that and add another spread to it. And she opted to do that for a 1%. She kicked in a full 1%. Now, remember, even though these yields I'm talking about, when we talk yields in the bond market, they're all annualized, right? This is 5.25% you're earning annualized. For 6 months, you're only earning 1/2 of that amount. Back in the days when we were talking about 9%, that was the annual yield. Mm-hmm. You only actually earn that for 6 months. So when the coupon resets on May, the new rate, which everyone will enjoy, the new rate will once again be a function of whatever the inflation component is, which looks like it could be a bit lower, and whatever Janet Yellen chooses to do the night before, in terms of giving us a little bit more spread. And then that will be good for the next 6 months.
Right. I've got it up here if you guys want. You go to treasurydirect.gov. There's all the info you want on iBonds. But you can see here it says iBonds earn a combined rate of interest. You have a fixed rate and you have the inflation rate. So the inflation rate is what we've been focusing on. But that fixed rate, it's right now it's 1.3% was the fixed rate portion of those iBonds. And that's Janet Yellen saying, oh, I'll throw in an extra 1.3. And you got to, I'm not the biggest Janet Yellen fan, but I will tell you, thank you, Janet Yellen. I really appreciate that 1.3%. You're going to make me, you make me another $130 on my 10-year bond or my $10,000.
Yep. But just so that everyone's clear, everybody only enjoys that until April 1st, by May 1st, when the news rate kicks in, and she'll decide how much to do then.
Yep. No, Liz, cool. It's just answering Liz's question. Whatever that iBond rate is, you're getting that new rate, right? So it doesn't matter if you bought your iBond 3 years ago or you buy it tomorrow, you're going to get this rate right here, which is 5.27, and that includes that 1.3% from Janet Yellen. Now, the interesting thing is, in April, let's say inflation falls to 3%, right? We get to the Fed's target of 2%, 2% inflation. If we get to 2% and Janet Yellen doesn't put any extra juice in this, you're going to get 2%, right? So
everybody who gets 2%.
Everybody will get that one. Yep.
Right. Sorry, I interrupted.
No, you're great. But yeah, it's for everybody who's jumping into the bond market. So one other thing that came up during the press conference, which I thought was interesting, and talk to me a little bit about the repo market. Is there anything significant or noteworthy about that repo market that may be of concern going forward?
I wouldn't use the word concern, but the repo market is showing us what the other numbers are showing us, is that liquidity is starting to diminish. What the Fed's trying to do is working. because and repo is a tough thing to explain, but the repo market for your audience is a market most people don't know about, but it's actually the largest market in the world in terms of dollar amount. Every day here in the US, almost $8 trillion a day trades in repo. It's bigger than the equity market, the currency market. Most people have never heard of it. It is the financial engine that drives our economy. But if a repo is where the Fed was saying to banks and to asset managers, give us your cash. You're swimming in cash. You're boatloads of cash out there. So send your money to the Fed, and we will pay you an attractive rate of return for us to hold your cash. And therefore, the banks won't be using it as part of their lending base. They're literally trying to suck money out of the economy. And they've always done this with banks. And the way they do this is through this mechanism called a repo, because the Fed takes in money from the banks, but gives them collateral in return. This is a very safe trade. So it's an exchange of the Fed's collateral for cash. Now, the Fed has always done this with banks. But what they did coming out of the pandemic, because again, they were trying to suck all this excess cash out of the economy, for the first time ever, they said to asset managers and money managers, if you want to do the same thing, we'll take your money too. So the Fed has been sucking in all this cash from asset managers, portfolio managers. I mean, I will tell every one of your audience members, if you have a money market fund right now, your money market fund probably has more repos in it than any other product. You're actually invested in repo if you have a money market fund. They love this product because it's a short-term investment, but look at the yield curve. Those are the highest rates, right? The reason you guys are finally earning yield on your money market funds is because the repos are starting to pay interest. So the Fed has been sucking in all this money, but paying a very high rate of interest to do that. That's why the Fed lost money last year for the first time ever. Because they're paying portfolio managers 5.5% to just hold their money. And we had over $2 trillion of this money was being sent to the Fed every night. But what's happening over time is very consistently that money is going down. The amount of cash that these institutions have to take advantage of this from the Fed is diminishing greatly. And so much so that they're even starting to talk about maybe the Fed doesn't even have to do this at all anymore.
I was just going to say that, like, I was going to say, is that part of the agenda of the repo market is to remove that cash? If that cash that is in the repo market is dwindling and getting smaller and smaller, I mean, is that the objective, so that there isn't that cash in circulation?
Exactly. The whole purpose of this was a maneuver to suck liquidity and cash out of the market. Yep.
Wow.
And it did it very effectively.
Apparently it's working.
Yep. No, that's what I say. For those people who are dubious, when we talk about the actions of the Fed, it sounds so subjective. But when we look at how M1 is going down, quantifiably, when we can look at the Fed's balance sheet going down, quantifiably, when we know the numbers on this repo going down, I'm not, again, they're a client, and I have to disclose this stuff when the names come up. They're a client of mine, but I have no qualms about saying that I understand the suspicion a lot of people have about the Fed and motivations, whatever discussion. From an economic point of view, it's good to be able to see that what they're trying to achieve is in fact being done.
Yeah. I mean, look, we can all play Monday morning quarterback and say what we want about Janet Yellen or Jerome Powell. I sure as hell wouldn't want either one of their jobs, and I want that kind of stress in my world.
I'm with you.
Tough stuff.
Not for the government pay. Not for the government pay.
Yeah, right. Walk me through your upcoming schedule. I know we've got some people here who have taken your classes. He's got a couple different ways you guys can partake in some education from Bill outside of this program. What do you got cooking for you, education-wise?
Yeah, so on my schedule OTA, we've now got that fixed income focus series, focus class called the Canary in the Coal Mines. And we've now done 2 of those sessions, which means we're now on a weekly basis. So every week at 2:30, I have the opportunity to get together with the alumni from that class, and we can talk about what's going on and current. So that's been a lot of fun because you can get some continuity going with the audience. And our next focus class is not until March. We do those on a quarterly basis, so we'll have that one day. We'll worry about that down the road. But that is on the agenda. And then for February 21st, we're going to do the XLT that I do every month. And for that, we're going to talk a little bit about that T-bill ladder that I've been talking about. But I also know, I know bonds can be confusing to people. And when we talk about bond yields, there's discounted yield, there's current yield, yield to maturity. I kind of want to walk people through a yields 101 conversation. Let's try and demystify some of that.
Nice.
Many people are starting to take advantage of that T-bill ladder. So I really need to explain what a discounted yield is versus an investment rate and the things that people are seeing on their confirmation. So there'll be a little bit of math for, I'm going to call math for dummies, not to insult anyone, but we're not going to get into the math. We're just going to get into what the concepts are. And then product-wise, it's time to talk muni bonds again.
Yeah.
Munis, the municipal market held up real well during the pandemic, and interest rates being so high. If you think the Fed is going to drop rates, you might want to think about extending maturities. And if it warrants it, municipal bonds, tax-free income.
All right. So there you guys have
Munis will be the February.
I got your calendar up there. Thursdays, 2:30 p.m. is his weekly companion session for his Canary in the Coal Mine focus course.
Right.
The February 21st is XLT, which is going to be covering a lot of understanding bonds, municipals as well. And then his class, his full Canary in the Coal Mine bond class, is on March 14th. So we got that information out there. And so one last question that popped in here for you. I think I've asked you this before, but Chio has asked this one. He says, what does Bill think about Bitcoin? Can't print anymore, Bill. You can't print it in infinity.
Right, exactly. I wish they would change the name.
Yeah.
And make it bit asset. Because let's be honest, I don't know anybody that's using this as a medium of exchange. When this all started, I wanted to be an investor. I bought some, but I really looked at the merchandise aspect, seamless transactions across borders. I was looking for PayPal and Square to provide clearing services in Bitcoin, so it actually could be used as a currency. Here we are years later, it's not a currency. So I like the technology. I have a problem. I will be honest with you. I'm a former trader. My life was as a trader at Lehman. And my background is you buy things that are cheap and sell things that are expensive.
Right.
But I don't know how to do a pricing model on Bitcoin. Is it cheap today? Is it expensive today? To what?
Right.
So I have a problem trading the product, and I don't trade the product. Am I fascinated as an academic exercise, and do I want to be on board? Absolutely.
Yeah.
But it's not a coin. It's not a currency.
Yeah, not yet. And I think that we have to get adoption, right?
Absolutely.
And the thing that for the viewers out there, most of you viewers on this program understand it, but like, what incentive does a government have to use it? There isn't one. I mean, it would be horrible if our government adopted Bitcoin. They could not do what they do. They couldn't print money. They couldn't fund operations. They couldn't just do things and let's hit a button and make more. That's why so many people like myself love it, because it's honest, it's pure, it's true. However, Bill's right. The infrastructure there is not set up yet. You can use applications like Strike, and I can use an app with Strike and use Bitcoin in the back end and make payments at Starbucks and buy things, but it's not mainstream yet. But you're seeing that slow adoption. And my thinking the whole entire time has been, talk about 10 years down the road, I think you'll start to see much more adoption. And then maybe we can ask that question again at that point. But yeah.
And I would welcome that. I predict that as well. It's just happening. The currency aspect adoption is happening slower than I certainly expected it to.
Yeah. And I think that'll change a lot once we get clear guidance and regulation from our regulators. I mean, we currently have so many lawsuits going on with different, crypto exchanges over, it's a security, it's not a security. And I mean, come on, man. It just drives me nuts that these guys can't figure it out.
I just want to be able to use my Bitcoin ATM card.
There you go. I just want to hold it. I don't even want to get rid of my. See, that's the thing. I love Bitcoin, but I'm not using it. I want to hold. I'm a hodler. I'm a hoarder of Bitcoin.
I'm not a trader either. As I said, I got in. I'm enjoying watching it. The best way to watch it is to have some money in it.
Yep.
But I don't trade it. I can't price. There's no pricing model.
Yeah. Yeah. All right. Cool, man. Well, hey, thank you very much. I appreciate you coming on.
Always a pleasure.
Almost seems like almost a monthly visit we get you on. Maybe once every couple of months.
Every 8 weeks at least, right? Every FOMC meeting.
I think it's pretty much it. Yeah, about every FOMC meeting. Well, we'll see you at the next one then. Which, here you go. What's your expectation for the next meeting? Right now, I'm going to bring up the probability chart here for everybody so you can see it, just so you know where we're at. 61% think we're going to stay exactly where we are, and 39% think 25 basis point cut.
And by the way, the cut argument was over 70% at one point, just like 3 weeks ago.
Yeah.
So those people who think we're going to be cutting are getting most fewer and fewer. And I was never looking for a cut. I think we're going to be in this rates for a good period of time.
Yeah. Okay. I'm with you. I think it's
what makes a market.
Yeah. I think we're on hold until either the data is unbelievably good for our economy or it all goes to hell in a handbasket. And one of those two extremes needs to happen for us to move off of this point right now, at least in my opinion. We'll see. We'll see.
We agree. That's dangerous. We both agree. There's no beer to be bet.
No beer. You still owe me 2. Get out to California so I can take you up on that one.
Hey, done deal. Glad I mentioned it.
Yeah. No, exactly. Oh, trust me. I've got a little list here of who owes me what. You're on the hook.
Happy to pay.
Awesome.
When the time comes, happy to pay.
Looking forward to it, my friend. Well, thank you so much. Enjoy your focus classes, and I will talk to you again soon.
Be well to everybody.
Right,
Thanks for having me on.
Take care. Take care.
Bye now.
Guys, that was Bond King Bill Addiss. You can get more information by going to his website, which I have up here. It's aftraining.co. You guys saw his little book special there. He's going to be discontinuing those books. They're very basic. So I don't want you to think that these are like super high level. But if you go here to shop, and click on that little shop tab, it should open up here. You've got this little 3-book set. $25 for all 3 books is a pretty damn good deal. There's one on equities, there's one on derivatives, and one on fixed income investments. So if you are new to the trading investing world, want to learn more, great books, and Bill had a heavy hand in the creation of those. All right, Big Eb says they won't cut. Why would they? They will cut because of market pressure, in my opinion. I don't think they're going to cut because the economy is doing so well. I think they're going to cut because they're getting pressure from the banks. The banks want that cut. Banks want the economy to be more stimulated. At least it would be my take on it. At this point, the prudent thing to do is just stay where you're at. If those rate increases were having a significant damaging impact on the economy, then you start to cut. But we haven't seen it, right? We have seen the housing market slow a little bit. But let's face it, you went from 25 basis points to 5.5. Of course you're going to see it slow down, but it didn't slow down anywhere near as much as I think people were expecting, including myself. I actually thought that it was going to come down much more significant than that, and it did not. So at this point, if I'm Jerome Powell and the FOMC members, like, hey, we raised dramatically, the market's not suffering, let's hold it here until inflation continues to tick lower, which it has been doing. So Larry M says on Kindle, I don't believe so. You might be able to go find it on Amazon. I guess I could check that one for you, but let me just wrap up my show here so I don't go into another hour. Real quick, let's go look at what happened to our markets today. I mentioned I want to talk a little bit about earnings. I'm going to run through a few of them here. Here's Meta. So Meta's numbers. This is Facebook. Earnings per share. They made $5.33. Expectations were $4.91. Revenue. They beat by $1 billion. $1.1 billion more for Facebook. And I remember yesterday I said I think Apple's going to miss. I think Amazon's going to beat. And I think that Meta is going to beat. Well, I was right on 2 out of 3. We'll start with Meta. A huge earnings beat on revenue. You go down the list here, and here's ad revenue. So they beat by $900 million on ad revenue. Their family of apps revenue was up over $1 billion. So, I mean, they were kicking butt in just about every single category for Meta. So congrats to Meta. Their users even increased. So Meta absolutely killed it, Oliver. Yeah, look at this. Look at them after hours. 1 second as I bring it up here. Yes, I'll make sure you guys can see it. Right now we're up 13.8% on Meta in the after-hour session. And this chart looks unbelievable. But now all of a sudden we've got another gap up. Notice where that blue line is. That's where Meta is at right now. So Meta is at an all-time high. Here's your 5-minute time frame of Meta just to see what it has done in that after-hour session. It has been, without a doubt, your biggest popcorn. The chart looks just like that, doesn't it? Except it hasn't come back down. The popcorn trade of the day. There's your Meta. And it looks like it's starting to roll over a little bit right now, but still most likely this is going to open up with a tremendous gain tomorrow. But that wasn't all of the companies reporting earnings. Let's go to our next one here, which is going to be Apple. This was a little bit different. You'll see why in a second. So Apple beat on earnings, $2.18 versus $2.11 expectations. So they beat by 7 cents. That's great. Their revenue was better than expected, $119 billion versus $117. So great. They beat by $1.6 billion beat on revenue. That's 10%. Great. Okay, well, hold on a second. Next is 1% beat. Here's where we start to see some problems. Product revenue for Apple was good. iPhone was slightly better than expected. So 69.7 versus 68.5. So they were 1.2 billion higher there. but their iPad revenue slowing down. You had your Mac revenue slowing down. And here's the reason I think that they're tanking in the after hours is Greater China revenue dropped to 20.8 billion from 23.5. Clearly a slip in China with regards to Apple's sales. And this is obviously a monstrous market. So that is a big portion of it. If that trend continues, then I would expect their earnings per share guidance to be lowered here. Now here's what's going on with Apple. AAPL down 3.4% in the after-hours session. Probably the only thing saving my short right now, but I think Amazon and Meta are going to bring this thing up even higher. So that's your bad news was Apple. They did beat earnings. I thought they were going to miss. I thought they were going to be down as well. So I got the down part right, just not the earnings miss. Now, the last one that we'll look at is my favorite company, Amazon. Amazon's earnings per share, they came out with $1 per share versus 78 cents expectations. Net sales went to $169.9 billion. They beat their expectation by $3.7 billion on net sales. Damn, Amazon. I think $1 billion of it's mine. That's all the crap I buy from them. North American sales went up to $105 billion from $102. So again, you're talking $2.7 billion increase in North American sales. That's phenomenal. Amazon Web Services was slightly down. They dropped by $80 million. Big deal, right? $80 million is a drop in the bucket for Amazon. Physical store sales. That was interesting. I've actually gone and used the the Amazon stores, Amazon Fresh. Interesting concept. I don't know, has anybody here used those? Where you have a little computer and you scan everything in your cart and you just kind of walk right out the door. It's kind of it's interesting, although the first time I did it, complete fiasco. The computer was wrong. It was repricing things all awkwardly. And it's like, I like the idea, just not there yet to have me just kind of push the cart in and walk out the door. But it was a nice idea. It just didn't work for me. And I probably won't be using that service again anytime soon. And I think, operating margins. This is, I think, the biggest number for them. They went from 6.17% operating margins to 7.8%. That's a pretty big jump in operating margin overall, given the number of sales they've done. So Amazon, let's take a peek at their chart. For a second as I bring this one up here, AMZN. Oh, giving back some in the after-hours session. Right now it's up 6.29%, but it was up over $174 per share. Now you're down below 170, actually at 169. So all in all, great day for Amazon, great day for tech. If you look at our broader markets here, let's just go and show you what the futures have done. You have the pullback a little bit. It looks like the pullback here. Hold on a second. Let me bring up 5 minutes on the NASDAQ. That's odd. I'm not getting the full picture here on this NASDAQ chart. It's odd. But I'll run through your top 7 real quick and then I'll wrap up. Crude oil continued its slide. I was really optimistic that we were going to hold this line right around 76.18. Did not. Now ultimately looks like we're going to come back and challenge these lows around $68 on crude oil. I mentioned yesterday also you got to be careful because of OPEC. That's the big wild card here for for oil is what's going on with OPEC. So careful with that. Dollar index, the dollar down 0.43% today. The biggest red candle we've had in 3 weeks. Slightly down, by 0.43%. I wouldn't say it's actually cleared out of this consolidation. Give it till tomorrow to see if we actually get lower there. Your 10-year again, continuing to slide. We talked about it a couple days ago that if it does break this area of demand that was in yesterday, that your next target's these lows of 3.78%. We actually tiptoed right down to that area today. So it's going to be, what did you say? I used Amazon Fresh a couple of times. It was okay. It's going to be 60. What are you talking about? All right. Gold, 0.18%. Not a great technical picture. Silver actually looking better today. Was happy to see silver have a nice percentage gain of 1.43% for silver. That's great. Again, I told you I'm not sold the calls against my positions in silver yet. I'm waiting for a little bit of a rally here to get some legs underneath it. I think that once it gets around that 22, maybe 21.50, I'll look at selling some calls against my position. All right, Bitcoin up 1% today. Give me where's my Bitcoin chart? There you go. Technically, nothing to speak of here with that candle, but this is really the talk track is your NASDAQ, which came down to that 17,217 level, which I'd mapped out as a demand zone on the hourly time frame. Hit it yesterday, bounced off it today, and of course the tech rally pushing this one up. We'll see what happens on Friday's session. S&P also loving the move up. That little move up today set an all-time intraday high for the S&P 500 before selling off a little bit. And all in all, a great end to the day and a great start to February's trading. Now, we mentioned Russell, the canary in the coal mine, we like to call it, or I like to call it. Nice bounce up, recouping some of those losses we experienced yesterday, but all in all, still not the best looking day for Russell. The chart doesn't look as good as some of these other ones, so there we go. All right, that's going to do it. I want to make sure I had no more hour shows. I got stuff to do, man. I got stuff to do. ETH. Yeah, ETH, depending on the ticker symbols out there, crypto was all over the place as it typically is. And Ethereum on the day, or at least yesterday, had a pretty sharp sell-off. There's your ETH chart. Technically, it doesn't look that great, although, you could argue that the 5-day rally up has been good. I'd love to see us back above $2,700 here, but that's going to have to wait. Nice 20% sell-off since that Bitcoin ETF went live. All right, let me bring up your economic calendar and your earnings calendar. Here's what's cooking for Friday. Bring up Friday's calendar. It is a big day because we have two major jobs pieces of data. Number one is going to be that non-farm employment change, but the biggest is unemployment rate. It is expected that the unemployment rate is going to tick up from 3.7 to 3.8%. While that may seem like an increase, it's really not that big of a deal. Like I say, I think if we get above 4%, then it'll start to become a bigger conversation topic. But come on, 3.8% is so historically low, it should not be really an issue at all. Now, on the earnings front, there's really nothing to speak of with earnings. I think we've got ConocoPhillips. Let me bring up that earnings calendar for you. Take me a second just to bring it up because I was not prepared, as you think I would be prepared on the show every day, but sometimes I just drop the ball. So here is your earnings calendar for tomorrow. Yeah, you've got ExxonMobil, you've got Chevron, so a couple oil companies. You've got AbbVie as well, and Bristol-Myers Squibb. So that's your Friday earnings calendar. It will be a quiet one. It's the first Friday of the month. That's right. So for the options guys out there, it makes it look a little bit weird, right? When you have the first or second day of the month is a Friday. That means that your options for this month are going to expire on the 16th of February. Yep, non-farm employment. We had ADP non-farm employment earlier in the week. So yeah, just basically a lot of jobs data this week. I'll bring up your economic calendar for the week just so we can look at that one. Go calendar here, show you the week. And we could potentially, there's ADP non-farm employment was on, where was it? Should have been actually, hold on a second. What are we doing here? Was I off on this one? Hold on a second. I think maybe I screwed up. I did screw. No, there we go. Like, wait a minute. Things are all messed up. I thought ADP non-farm employment change was much earlier in the week, which it was, and there it was. So we talked about that one on Wednesday, which was a pretty big decline in ADP non-farm employment change. That's, I think, what has a lot of people concerned about the jobs market. So we went from 158 down to 107 on that one. So there we go. All right, guys, that's going to do it for me. I hope you enjoyed Bill Addiss on the program today. If you guys have comments, questions, feedback, things you want me to discuss, it is going to be a Friday show tomorrow. Next week, I may take Wednesday off. I have to do a lot of filming in my new studio, and I've got some talent coming down, so I may actually have to take that day off to record. But for now, I'll be doing shows definitely Monday, Tuesday, Thursday, Friday, and, of course, I've got our show for tomorrow. So got something you want me to cover, talk about, give me an email at TraderMerlin@gmail.com or down below any of the YouTube videos. That said, have a fantastic remainder of your day, everybody. I will see you tomorrow for the Apple, Amazon, and Meta fallout for our Friday. Take care.